My name is Miley Wong, Senior Wealth Manager, Senior Portfolio Manager at the Wong Group at Wellington Altus Private Wealth. And I'm delighted for you all to join us today at our Wealth Matters client event, all about the world in transition, data, discipline, decision-making in the age of AI. Today, we gather at a very critical time, a time of geopolitical uncertainty, shifting alliances, trade negotiations, questions about our sovereignty as a country and about our own independent defense. And so these are the times when it can feel really uncertain. And so our goal today is to help you feel more confident. Confident not just in predictions, but in the people, the plan, the process, all underpinning the foundation to protect and build you and your wealth. And so that is why we gather today to talk about the world in transition and focus the lens of AI more on how we're using it from an investment perspective to drive better outcomes. A few months ago, I was fortunate to attend a board meeting at the Asia Pacific Foundation of Canada, where I'm a board director. And we got to hear from geopolitical experts like Veena Najibullah, who is the VP of Strategy and Research at the Asia Pacific Foundation. Some of you will remember we had brought her into a previous Wealth Matters event at the Arbutus Club. And she spoke about the current moment and geopolitics. And this time we also heard from experts from Global Affairs Canada, and in particular, how the current moment, and ever since that speech at the World Economic Forum in Davos with our Prime Minister Mark Carney talking about the middle powers and the call to action for Canada to be an example of a country who can work with other countries to find a better way forward. Now we are enjoying in Canada this almost honeymoon period of global relevance where trade negotiations, partners in which we do business with are being diversified. And more than ever, from an investment standpoint, are we finding it is so important to have the tools and resources to be able to look beyond just our Canadian borders and beyond the US borders to find opportunities globally. And we have been doing this for you in your investment portfolios over the past year and a half. That's good news. The even better news is that we're committed to always finding a better way, and opportunity sets are broadening. And just as the markets have been shifting to reward companies, not just in North America, but globally, we too have been seeking opportunities to enhance portfolios with better risk reward, risk management, AI, tools and resources, and partnering with companies that have deep resources, like the ones that I'm bringing with you today to introduce you to two world-class organizations that have decades of institutional track record, depth of resources, that I'm really excited to have flown in today just to share with you a behind-the-scenes look at how some of the top wealth managers in the world implement these tools to drive better investment outcomes. I'm really excited to share with you how we are evolving and deepening the resources in your portfolio. You're going to hear from two world-class institutional professionals whose companies are considered some of the best in the world. We'll hear from Richard Matheson, Managing Director at BlackRock in systematic equities. And BlackRock, as many of you will recognize the name, is probably the world's largest asset manager with over $12 trillion in assets under management. And with that amount of scope and scale, there's a lot of depth of resources that can go into the research and technology, which we're going to talk about today. And he's going to demonstrate some of the leading edge tools that allow us to find even more opportunities in the global investment landscape. You'll also get to hear from a fan favorite, Apollo Lepescu from Dimensional Fund Advisors, backed by popular demand. Apollo's known as the chief of explaining stuff. And he's known for being able to explain fairly complex things like what's happening in global markets today, what's going to happen with the US-Iran war, where are oil prices going, all of these big questions. He'll be able to demonstrate how we use data and discipline to identify where the risk-reward opportunities exist. And here at the Wong Group, we're going to bring it all together to help figure out the best ways to implement it in an efficient and effective way on your behalf so that everything aligns with your own personalized plan. So with that, what I'd like to do is to invite you both up to the stage, and we'll get started with our chat. How does that sound? Great. So, Richard, maybe you can tell us a bit about BlackRock and the evolution of the firm, and in particular, your journey with BlackRock, and then how AI has changed the landscape for how BlackRock works.
Yeah, so I actually started at Barclays in the UK, Barclays Global Investors. That business was acquired by BlackRock in 2009, which is how I ended up in BlackRock. Before that, the origin of the team I work for goes back to the 70s, and it was Wells Fargo in San Francisco. And they wanted to get into asset management. And they were going up against the established East Coast players, guys like Fidelity, State Street at the time. And they had this idea of to basically get into asset management, bringing a notion or a sense of data in rigor, in technology to the process. Now, back in the late 70s, telling your client their performance was almost impossible. The data just wasn't available. There was lots of fantastic theory about how portfolios should be run and managed, diversification, portfolio theory, but the technology just wasn't available. There was no real computers at the time that enabled that theory to be implemented in live investment strategies. And so they went about addressing that. And it gave rise to the first systematic quant strategies. And the first strategy that we ever ran was a $6 million portfolio for Samsonite, where we worked out how to replicate the market. It was the first ever index strategy. And from there, the next step was, okay, we've worked out how to replicate the market. How do we go about beating the market? The first actively managed quant strategy was 1981. And what we did back then was we measured the dividend yield of every stock in the S&P 500, and we built a portfolio that had very small overweight positions in the companies with above average yield and very small underweight positions in the companies with below average yield. 1985, we launched a product where we extended away from dividend yield to 5 factors: dividend yield, value, cheap stocks versus expensive stocks. There was a factor back then called success, which today you would call momentum. Stocks that have gone up versus stocks that have gone down. There was a growth factor and a size factor, small cap versus large cap. So 5 factors, and again, you just combine those scores in equal weight, fifth, and you basically went overweight, small overweights in half of the S&P 500 at above average score, and the half of the S&P 500 that are below average score. We still run that product today. It's called US Alpha Tilts. It's been around for over 40 years. And I think in something like 34 out of the 41 years it's been running, it's outperformed the S&P 500. Not by a lot, but you do that consistently over that amount of time, it becomes incredibly successful. Today, we don't have 5 factors. We have about 1,000 different insights and signals that we score and rank companies against that go into the same approach. It's, basically going overweight all the companies we think are going to outperform, underweight all the companies we think are going to underperform. In 1996, Barclays Bank in the UK bought Wells Fargo Asset Management. I joined in 2001. Back in 2001, the main constraint we had in this approach was data. We were very much like any investor, traditional fundamental investor or a quant, you were very much restricted to information that came from the company. If you were a traditional fundamental stock picker, you had the report and accounts, you had the regulatory filing, you maybe got to speak to the company management, but essentially you were just consuming information that came from the company. As a quant back then, there was essentially 3 data sets that mattered. You had WorldScope and CapIQ, where you had all the accounting information. And by the way, that's where I'm an ex-accountant. I'm not actually a quant. My boss calls me a recovering accountant. But we were basically building signals back then that said, let's take the earnings number from the accounting database, the asset number for the database, score and rank every stock. So you go overweight, high, above average return on assets, underweight, below average return on assets. But we were very much, again, using data that came from the company. We had a database that we got from a business called IBIS, which is today Thomson Reuters, and essentially that told us what analysts were forecasting in terms of future earnings, and you would trade the upgrades and the downgrades. But that was pretty much it. Think of something you want to know about a company today, and the chances are someone somewhere is recording that information electronically and it's publicly available. So as we went from 5 signals to 10 signals to 15 to 20 to 1,000 signals, the main change has been data. huge amounts of information out there, a huge electronic exhaust that give us a lens into the businesses that we're interested in investing in. Today, the main innovations that we're pushing into client portfolios aren't necessarily about the data, but it's the techniques and the technology we have at our disposal to model that data and ask the data different questions in a way that we were never able to do before. In large language models and artificial intelligence are very much at the forefront of that. And we've gone from a world where we were very much able to understand a little bit about a lot of companies. So think of the approach as being 1 mile wide but 1 inch deep, to today being still 1 mile wide. We can cover 5,000 and know something about 5,000 securities every single day. But with AI and large language models, we're getting deeper and deeper and deeper in terms of replicating the type of analysis that any traditional fundamental manager would be able to do, where he's typically one inch wide but 1 mile deep. So those two are converging, and we'll have a look at some examples of how we're doing that.
Great. Thank you very much, Richard. So AI is changing how you assess data and how you can assemble the insights from the data. Can you talk about how you're able to use it in some specific examples, perhaps?
Yeah, maybe if we can, maybe we've got a demo here. Maybe if I can get this fired up. So what we're doing here, we call this scenario-driven recommendations. This is a signal, the way of picking stocks that we've been trading in live portfolios for around 2 years now. The source data here is broker reports. We actually receive 6,000 pieces of sell-side research every single day. Now, I don't read any of it. I don't want to read 6,000 broker reports a day. The machines have always been faster at reading broker reports than a human. And the punchline is, with large language models and artificial intelligence, they're getting better and better and better at picking up one broker report, reading it and interpreting it the way you or I would. Now, the main use case for this is trading analyst sentiment. The large language model reads every report and identifies where the analyst is becoming more bullish or bearish on the outlook for the company versus his last report. And we aggregate that up across all companies, across all brokers. And we want to be overweight the companies where sentiment is improving and underweight companies where the sentiment is deteriorating. And again, the large language models have just enabled us to do that better and better and better than we ever would be able to do in the past. This is a slightly different use case. We're still using broker reports, but we're asking a very different question here. What we want to pick up from those broker reports is emerging themes or scenarios that are starting to play out in the market, and make sure our portfolios are positioned to benefit or exploit the winners and losers of those themes. And that's what we call the SDR portfolio. So here's a little bit of a toy model. So we actually passed the broker reports through 2 queries in the large language model. First of all, we basically ask it to summarize, read all the reports and summarize the key themes, any themes or scenarios that you can extract from what the analysts are talking about. So in this example, it's highlighted a theme: spot container freight rates expected to decline over the second half of 2023. We then basically push that scenario through a second query where we post it into a large language model and say, if this scenario plays out in the market, what stocks would you want to be long or short? And it basically tells us the recommendations that go with that scenario. So in this situation, it's saying recommendation short, shipping company A. That's basically the kind of company you'd want to be short if spot container freight rates are expected to decline over the second half of 2023. So this is a little dashboard we built to pick up on some of these scenarios. We call it the SDR Explorer. What we're looking at here is NVIDIA's share price. The orange line is NVIDIA's share price. We're tracking it all the way back to, I think it's 2000. And then you're looking at the number of recommendations for NVIDIA that this model picked up on from the data. And you can quite clearly see, as we came into 2024, it went crazy. So more recommendations, basically share price starts to rise. And that was around the first time NVIDIA started reporting results that were way better than expectations. That one's a little bit obvious. Everybody knew about this back in the day. But what this is incredibly effective at is picking up on some of these less well-known scenarios, themes, in giving us a much broader set of opportunities to trade in portfolios. The example that we've picked up on here, and we've sort of basically hovered over we've actually asked it for a query on nuclear. And it picked up, and this was sort of mid-24, it picked up on a theme that was all about nuclear reactors in Japan not coming online on the schedule that was originally expected. So this was post the Fukushima disaster. Nuclear reactors have been shut down in Japan. It's an incredibly important source of power for the Japanese economy. They weren't coming online in the timeline that the market had expected. This was picked up in our analysis of the broker reports. In the scenario-driven recommendations model suggested that we want to be overweight exporters of liquid natural gas into the Japanese market and underweight Japanese manufacturing companies that had a very, very high energy input cost. And reality is, if you look in any given year since we went live with this, we're picking up round about 1,000 of these underlying scenarios in probably about 2,000 to 3,000 individual trade recommendations that we can build into the portfolio. And that was never possible before we had large language models. This is quite interesting. This was the research. This is how we would think about sort of, is this something that's going to work? Building portfolios using this approach, in the research, if we built a market neutral portfolio of 5% risk, you can see the line on the left-hand side is how that performed. So that was what we basically gave us comfort that this thing actually was useful and we wanted to trade it in live portfolios. On the right-hand side, and it stops in the middle of 2005, this is the live experience. So if I'd just been trading a market neutral portfolio at 5% risk, over the time that we went live with this, that portfolio would have delivered a return and a pure source of alpha of close to 10%. So Sharpe ratio of 2. So quite unusual, actually, that this is a piece of research that we did where the out of sample, the live experience has almost been just as good as what we saw in the research, which is actually not always the case. Right, maybe one more example. So that was more of a top-down model where we're picking up on top-down macro themes and working out what stocks to trade. This isn't something that we've gone live with yet, but it's something that we've been building out and I've been directly involved in. What we're doing here now is trying to use a large language model to entirely replicate the pipeline of a traditional fundamental analyst. We're basically going to feed the large language model all of the data that a fundamental analyst would be interested in, the financial statements, the reporting accounts, the broker reports. We're going to ask it to go along and meet the company management. Now, I have never met a company management team. We don't do that, but we can pretty much do it because we can get transcripts of all the meetings they have with investors, including their quarterly earnings call. We're going to feed all of that information and ask an LLM to summarize it. And then based on the summaries that the LLM has, we're going to ask it to rank the company and comment on a number of different metrics that we think are important for understanding whether or not, to guide us whether or not we want to be long or short the stock. So pricing strategy, market expansion, CapEx investment, regulatory environment, financial health, inventory management, so on and so forth. So we're basically going to ask an LLM to analyze all of the information that a traditional stock picker would want it to look at and provide a recommendation whether or not we want to be long or short. Now, I'll kick this guy off. We're going to look here at Oracle. Now, I've picked this stock deliberately. It's been quite high profile. It's something of a poster child for the whole AI revolution. What we're feeding here, first of all, is standardized income statement, cash flow statement, balance sheet. This looks like a spreadsheet or a database, but it's actually text. We've built from scratch, using all the underlying line items, a 12-month rolling cash flow statement, income statement, balance sheet for every company, and we're passing that into an LLM with this prompt. And we're basically saying in this prompt, be a financial analyst. I want you to analyze all the numbers, do all the ratio analysis, look at how all these items are moving through time, look at how the company's growing, look at is it doing it in a sustainable way, and tell me what you think. And this is the output from that. We get this every quarter for every company. And the punchline here is, and I won't go into all the detail, but it's picking up on the fact that on one hand, Oracle's growing very, very quickly. Its revenue growth has been very, very strong. Its profit growth has been very, very strong. But it's increasingly growing in a way that is driven by its balance sheet. So massive amount of capital expenditure. Cash flow return on invested capital is starting to come down. It's got a bit of a liquidity problem because its working capital is going up and up and up and up and up because it's signing all these contracts, but actually isn't actually getting the cash recovery from them. And so it's becoming a little bit concerned, and it's actually on the very, very bottom recommending a short position, right? Now, that's just one source. That's just looking at the numbers. So the next thing we do is we ask the LLM or the agent that we've created to look at Oracle to go meet the company management. This is the transcript of the latest Oracle earnings call. And so we're, again, summarizing that transcript, and we're asking the large language model to comment on, okay, well, what was the company saying? Does it align with what you're seeing in the financial statements? And again, the headline here is actually the view's a lot more positive. And you can imagine, the management team are talking up the growth. They're mentioning here that for the first time in something like 20 years, they've had 20% both revenue growth and EPS growth. So they're very much focused on the positive elements of the financial statement analysis. They actually kind of gloss over some of the concerns about CapEx and working capital. And you can see this is one part where we actually asked the LLM to maybe work out what other questions would you want to ask the management team? Challenge, it becomes a little bit more challenging in terms of, challenging what the company are saying. We actually go down, I think, at the very, very bottom, we start to look at what the management team were saying in the Q&A when the analysts that were present at the call were asking them questions. And ultimately, I think the overall arching view of the analysis of the conference calls is that it's actually not as bad as the financial statement suggested. So that's acting as a little bit of a counter. What we'll then do, as we finish up on the conference calls, we'll start to look at all the other information. Again, 6,000 broker reports a day. Plenty of them are from Oracle. We'll see all those broker reports. We'll have the agent read those. Pretty much every piece of electronic news flow we can get that mentions Oracle, we will capture in this. The model will learn all about that. And so we're giving it all of this information, summarizing all the information, and asking the large language model to review it and take a view on the outlook for Oracle. We've also given it a bunch of static data, like where's the company from, what industry is it in, who is its competitors, suppliers. So essentially for every single company, every single day, we're building a little agent that essentially performs the role of a fundamental analyst looking at every single company that we're interested in. In the interest of time, I'll maybe skip on. This is another dashboard that we created to look at the output. And this is essentially Oracle again through time. The little dots are the rating we had. And you can see that for most of the period up until recently, we generally had a positive view. If you did this analysis every single day for Oracle, the model would come out with, you see a buy rating, and it will actually tell you exactly why. It will highlight the inputs and the information sources that were driving that rating. Now, for most of that period, when you look at what was supporting the buy rating, it was very much about the growth of the business. Then when you get into this more recent period, it starts to become a little bit more cautious and actually moves from a buy to a sell. And here it's actually starting to highlight a lot of the concerns it picked up from analysis of the financial statements, mainly the capital expenditure, the growth in the balance sheet, the deteriorating return on invested capital, and ultimately some of the liquidity concerns. Again, these are the key measures. You can actually see how those have changed through time, the things that we're ultimately scoring and ranking Oracle on. Again, you'll see that a lot of the more growthy type KPIs are looking very, very positive, but a lot of the more financial statement and the sustainability of the growth measures are actually flashing quite red. And then ultimately we have this overall analysis, which is going to be basically what we think about Oracle right now, and essentially the current sell rating, which is our overarching view. Now, we don't have this live just yet. It's been approved by our research approval board. We're in the process of putting it into production. But again, just to highlight, the idea here is that you're using these techniques to do the type of analysis that as a systematic quant investor we just never could before. The punchline is that we can do this every single day for thousands and thousands of stocks and build all of these views into very, very broad portfolios that deliver the type of consistent results that I highlighted earlier.
Very impressive. Very impressive. Thanks, Richard. It's the scope and scale of the technology and how it assists you in this process to identify opportunities across so many different securities is staggering. So I have a question for you about which of the large language models you're finding the most useful, and what are the resources you're putting into it as a firm versus just using what's off the shelf? Because I want to ask and poll the audience first. How many of you have played around with a ChatGPT, Claude, Perplexity, Copilot? Okay, a good number. And I would say that's a higher number than last time when we got together in October when we first talking about AI and, had that scary video. But so over to you, Richard.
Yes, and I maybe should have finished there was a slide in there that showed we actually use all of them. And one of the observations is quite often if you ask GPT a question and then ask Gemini the same question, they give you slightly different answers. And we've had instances where, a buy rating from GPT will be a sell rating from Gemini. And what we've actually found, you get the best results from using all of them in combining the views together, ensembling them. The other observation in all of this, something that we found is, these models have been trained using lots of data. You just can't believe the amount of data that goes into training a model like OpenAI. And they've been trained to be pretty good at answering any question you want to know the answer to. They're not trained explicitly for answering the question I want to know the answer to, which is what stocks do I want to be overweight and underweight in your portfolio. And we've actually found that you can really enhance the forecasting power of the model if you actually start to fine-tune them with your data to answer your question. So we have enterprise agreements with all the big foundational model providers, so Anthropic, Gemini, OpenAI, and we actually send all of our data to those models. And we ask them to retrain their models with our data included to answer the question. And that enables that they get better and better and better at answering that question of, what stocks do I want to be long or short, rather than just using their data and their model. The next step is, let's just do away with their models altogether. We are in the process of building our own LLM, our own version of AI, OpenAI, our own version of Gemini, where it's just our data, our compute. We are, I would say, hyperscaling, which is a very popular phrase right now. Massive, massive compute budget. We've been out there buying NVIDIA GPUs, and we're essentially going to build our own large language model. And there's already a prototype of that. And if I look at the results of that analysis, doing the research and how that model, that stock selection model performs, we're seeing like a 50% uplift in the return potential from just running it through our own model. I don't know if we'll ever go all the way there. And I think what will happen is we'll continue to use our model ensembled with the fine-tuned underlying foundational models. My hunch is that will still be the right answer. But that's essentially the direction of travel.
So, Richard, where does AI not have a role? I mean, is there still a role for human analytics as part of the process before implementation?
I mean, I think it's a tool, right, in my view. And again, I've spent a lot of time working on this, just getting the data in a structure and a framework that makes the most sense for the large language model. Like, putting those accounting financial statements together is actually quite a lot of work. You've got to pull every single line item for every single company's accounts out of a database, build these standardized rolling 12-month financial statements, turn it into a text format, pass it into a large language model, create the prompt that it basically enables it to get useful output, make sure the results look sensible and it's not doing something crazy. So there's a lot of human involvement at the process. And I would just see this as a tool that's making me better and better and better at my job, which is ultimately using data to pick stocks.
On that note, how has the process performed, the global systematic active equity?
Well, we've just, for the portfolio that we run for Wellington Altus, it's just had its best ever quarter in terms of underlying strategy. So yeah, our platform has been doing incredibly well, and a lot of these tools are helping drive that.
I should add that as part of our process, we have been curating relationships over the years, and one of them is with BlackRock that we're really proud to talk about that has never been available to Canadians before. So quite excited to be on the leading edge of that. Can you kind of bring this back to real world, kind of from a macro perspective, where we are with equity markets seemingly looking past some of the geopolitical tensions that we are hearing about that seem, Middle East, over in Asia. What do some of your large language models or perhaps macro data suggest about what we can expect from potential equity and fixed income returns over the next year?
Well, if I look at that scenario-driven recommendations, more, and I wasn't quite brave enough to do a live demo. That was pre-canned and pre-recorded, but it picks up on Strait of Hormuz, conflict in Iran. Those are scenarios that it's capturing and giving us recommendations around those. So if I look what was happening sort of through March and April, we were buying energy stocks. We were basically selling down manufacturing companies that have a large energy input. We were buying defense companies. We were selling down consumer-facing businesses, particularly consumer discretionary. And essentially what those scenarios are suggesting is that the longer and longer and longer the conflict goes on for, the bigger the opportunity for benefiting from being positioned in the winners and the losers of that conflict are. And we're moving portfolios generally in that direction. Again, we don't know how long the conflict will go on for, but it does know that the longer that duration, the more extreme the outcomes in terms of winners and losers. And I think our portfolios are well positioned for that currently.
Very good. Thank you, Richard. You'll have an opportunity to ask some questions in a little bit. I'd like to pivot and talk to Apollo Lupescu from Dimensional Fund Advisors. As I mentioned, Apollo has a really great way of explaining deep, complex ideas as well. From a standpoint of Dimensional, maybe you can walk us through how Dimensional looks at the world and relies on data and research and a very systematic process to drive outcomes.
Well, first of all, thank you so much for the invitation, and thanks to all of you for coming. And one thing that I learned today that I did not know, and we did not talk about this in advance, is that the founders of Dimensional were actually the people running that science group at Wells Fargo.
That's right.
And they were the first to develop what Richard talked as the market fund. And the market fund was basically in those days something like a horrifically bad idea, because what they were suggesting is that the effort that people put into picking stocks and doing all that research is useless. And what they said, instead of going that direction and picking stocks and do all that, what that science group found is that you're better off just buying all the relevant stocks in the US market, which right now it seems like pretty intuitive. Why not just buy all of them? But at the time, there was no real data to back that up. And they came up with that idea that let's create a fund. And imagine those, back in those days, there was an ad that Wall Street put out saying it is un-American not to try. And they were trying to discourage companies from doing it. So it took a lot of bravery from Samsonite and AT&T and all the large companies who said, well, the data is compelling. When you put the data in front of them, it does make sense. The one difference that happened afterwards is that the folks who were running the group, Mac McQuan and David Booth, who ended up founding Dimensional, they actually thought that one way that you can look at data is in the academia. And they did come from a very academic background. So what they did is they went back to the University of Chicago and they started talking to the professors who are at that particular university and asked them, okay, so what is it that we can learn from the academic community? And over the years, I think that the strategies in a way are similar because they're systematic. But the biggest difference is that what they found is that these academics, they do have some very powerful insights into the market. And over the course of the last 40 plus years, there have been roughly about 5 different Nobel winners who have been associated with these strategies. And what they're basically saying is that at the core is that something has fundamentally changed in investing. And that's something that all of you should know. What's changed fundamentally is that in the good old days, there was a gentleman named Benjamin Graham. And Benjamin Graham was Warren Buffett's mentor. And what he suggested is that if you want to be a successful investor, it is all about information. How fast can you get information about any particular company? How well can you analyze that information? And number 3 is how well do you process that information? So all of these things are really important to us today. So the reason that this is so important and what these academics have contributed is something that's really relevant to all of you. The first thing, how fast do you think information traveled to investors today? How long does it take for any information to get to investors? What's your thought on that? It used to be weeks. It used to be then days, months, whatever. Back in the 1930s with Benjamin Graham, it was probably in the minutes. It was probably in the seconds in the 90s. How long do you think it takes today for any information to reach an investor? It's almost instant. Everybody gets information incredibly fast. So that advantage that some investors might have had, I don't believe that it's necessarily benefiting anyone. The second one is how how is this information being processed? So if you think about that, if you think about how information is being processed today, everybody has the same information. Everybody has super smart PhDs and super smart. I mean, we have like 100 PhDs, or I mean, we have tons of PhDs. We have everything. Everybody has everybody. So today the question is, can you still get an edge by developing something and finding some information somewhere that somebody has not found, or your model is better than somebody else's? You can claim that, but the reality is the data shows otherwise. There's no real advantage into building super sophisticated model because everybody's looking at it. Everybody's looking at it. And it's so competitive, folks. In the US, there are more professionally managed funds than actual stocks trading in the market. It is crazy competitive. Everybody is a model. Everybody's a story. But we look at this. What these scientists found is that, what these academics found is that there is no real advantage because it is so competitive. Information travels so fast. It's a level playing field. And ultimately what it means is that today the markets have gotten exceedingly good and exceedingly fast at incorporating whatever news comes out into whatever the value of a business is. It's no longer the case that it's going to take seconds or minutes. No. It's very, very, very quick today. So the idea is that you no longer have necessarily an advantage. And there's one other reason that it's worth paying attention to. When you are looking at the value of a company and how the stocks are going to move, basically, yeah, you have all the information looking backwards. But does anybody in the world, including Donald Trump, knows what Donald Trump's going to do tomorrow? Nobody has a clue. Nobody has a clue, including himself. So how can he possibly say I have a forecasting model? Rather, what you have are different opinions. And what we found is that the best way to think about these opinions is that the market is the fundamental AI processing machine. Because all this information gets dumped into by all these market participants, and what comes out is a price. And the price is looking at everything backwards, every estimate looking forward, and that's kind of a fair value. Because in the market, for every buyer, there has to be a seller. You're not trading with a company, you're trading with somebody else who has a different opinion about this unknown future. So what we found is that a better strategy is not necessarily to try to look at each individual stock and make a forecast and a prediction, because it's nothing more like crystal balling, and I do have one, I just not used to that. But it is better than. So what these academics have done is actually introduce a different way to think about investing and how do you beat the market. And that's why they started Dimensional. The idea was like, how do you can actually do better? And there are 2 or 3 ways that you can do it. The first one is to be able to differentiate between different types of stocks in the market. Not every stock is the same. There are different stocks in the market. And if you can delineate based on an economic model and looking at the data to see if that backs up, well, that's something there. And the first that came along in the early 80s, late 70s, was this idea that if you look at businesses, do you guys have Shake Shack in Canada, in Vancouver? Do you know what it is? It's a burger joint. It's not any better than McDonald's. You're not missing anything. By the way, in the US, Shake Shack is a company that you can buy in the stock market, but it is not a part of the S&P. It's not large enough to be in the S&P 500, which is a combination of the largest stocks in the US market. And take Shake Shack as the poster child for smaller companies, and look at McDonald's as the poster child for larger companies. And what these academics found is that these 2 groups of stocks are different, and the size matters. Size matters. And what they found is that the smaller companies, they have 2 things. One, economically, they have a greater opportunity to grow. If you look at Shake Shack and McDonald's, which one of these is going to theoretically grow and double in size easier? Shake Shack, right? But on the other hand, there's more uncertainty associated with a small company. It's not as mature, not as track record, and all this stuff. So if you're an investor, if you had the choice of putting money in the 2 of them, why would you give money to Shake Shack and not just McDonald's, since it's more, safer and quote unquote? Well, I got to get paid more. And that's what data showed, is smaller companies over the long run, they do tend to do better and grow your money more. So the idea is, what if you develop a fund that is purely for smaller companies and another one for large? And you give somebody a choice. Do you want larger, they're safer, or smaller, or not? They can grow more. And then along the ways, Richard mentioned this idea of value growth, which value growth basically means is that if you're looking to buy a company, how much are you paying to own it? That's what it means. And you have to look at what can I measure today, which is earnings or how much money the company makes, what assets it has, relative to how much you pay. And you can compare. It's like the easiest thing to think. How many of you look at real estate per square foot? If you have 2 apartment buildings on the same block, one that sells for $300 a square foot, the other one $800 a square foot, it's the same per square foot. Which one gives you an opportunity to grow and make more money by flipping it? The lower cost or the higher cost? The lower cost in the world of investing is called value. It just simply means that you're paying less per square foot, per whatever metric you want to use. So what data show and what these scientists showed is that, hey, if you look at these companies as a whole, they tend to outperform the more expensive ones. So that's kind of the fundamental premise of what we try to do, is use data, use this academic science to create funds that emphasize these parts of the market, like smaller companies or value, that over the long run have delivered greater investors, but not by picking stocks. And the best analogy that I came up with is from my mother-in-law. So I told her, when I was in Florida and I did go swimming in the water, it's nice warm water there is a school of fish. And when you look down at the school of fish, every fish moves quite randomly, up and down, left, right, side. There's no way you can predict how each fish moves. But once you swim a little bit longer, you realize that you can get a better sense of the behavior of the entire school of fish than any one fish. I have no idea which one's going to thrive or die, but I have a better sense of the school of fish as a whole. So the system that developed through these academics and what Dimensional pioneered is this idea of an asset class, what's called an asset class, where you don't really care about any one fish. You try to understand the behavior of the entire school of fish and then capture that for investors. And that's what I think it's really interesting. And we've done it for 40 plus years. We crossed the $1 trillion in U.S. assets, which is not quite 12, but our goal is to be very specific to a certain group of investors. We don't have retail funds. We never opened the funds to individual investors directly. It's always been our contention that having an advisor like Miley in the mix is hugely important for the success of your financial journey. So that's just at a high level, sort of like similarities in a sense. In fact, I had no idea. I had no idea that our founders were basically in the same group where you were. So that's kind of a good to know.
I think I always wondered, similar starting point, but I do think there was maybe a disagreement at some point where, we'd done that, okay, we've matched the market, let's go and beat the market. And I think a philosophical difference was the Dimensional view was it's very, very difficult to do that. And so Mark McCoe and Booth went off and created the business at that stage. We went down the active route, and Dimensional did what they did, and we've both been kind of right.
Exactly right. So it's both. I mean, but I think what I like is that it's both based on data and science. It's not like an opinion or something. It's just, I don't think you can go wrong with it. And there's also like something that we're not even, it's too beyond the scope maybe to touch on the implementation. How do you actually go and execute? Because you have this idea, great. Think of Uber. If somebody tells you, hey, I have an idea for an app, that what if you can see the car coming to you? Great. But you have to execute it. You have to somehow actually make it work. And all these little things that make a difference. And ultimately, that's who wins the day, is the execution, not just the big idea. Yeah, I have a big idea. Great. I have an idea for a movie script. I've had tons of those. I never wrote one down. It's the execution that kills you.
Absolutely. It's in the execution of being able to implement these ideas based on size, value, and also profitability.
Profitability. I wouldn't even get there. Profitability is another dimension that you can look at. Yes.
So back to the way that the philosophy behind Dimensional and the fact that current moment we're in very much a world of transition.
Yeah.
I've heard from some clients, this time is different, Miley.
Yeah.
And I would love to hear Dimensional's approach to answering that question when you have lots of data, but it feels like this time is different.
Well, It's interesting because not too long ago, my sister-in-law kind of like asked me the same question. It seems like it's different this time, and my first knee-jerk reaction is, "No, it's not different. We've seen something like this in the past." Blah blah. And she looked at me for about 5 seconds. She walked out. She's like, "I'm not listening to you," and it kind of made me think, like, what I did is really disregard something that is quite obvious. It is different this time, folks. It is absolutely different this time. And it really got me thinking a little bit deeper about this idea that is it different this time? And the answer is absolutely is it unlike anything else that I have seen in my lifetime. The same way that 6 years ago, all stuck at home, that was different. So the question then becomes, if it's different this time, does it mean that the old rules don't apply anymore? There's sometimes like a new paradigm and you have to completely change the way you think. And as I thought more about it, and going back to the pandemic, do you remember that show, The Queen's Gambit? You remember that? It was about chess. And this is like when you're home alone. I mean, the kids were there, whatever. And I started playing chess. I downloaded an app and I started playing chess. And what was interesting is that the more game of chess that I played, I never ended up in exactly the same position. It was always different. Anybody plays chess here? Do you end up in the same position? Never. It's always different. It's always different. So the thought that crossed my mind, is it possible that it is different this time? The same way that a game of chess ends up in a different situation, a different position every time. And yet at the same time, the game of chess has some premises that don't change. You have 64 squares, you have the chessboard, you have 16 pieces on each side. That doesn't change. So the question is, what is almost the chessboard of investing? Is there such a thing, a premise that does not change even as this particular situation is different? Do you think there's such a thing? Yes. What do you think it is? Just out of curiosity, because it made me think for a long time. Huh? To me, the chessboard of investing, which is fundamental, is the idea that when you are buying a stock, you are not placing your money into a gambling casino. You are buying ownership into a company. That's what you're doing. You're buying ownership into a company. That has not changed. And what we find over and over is that in free markets, companies will find a way to make money irrespective of the state of the world. Would you agree with me? In the pandemic, when cruise lines didn't have passengers, well, they laid off staff and they brought them back. We all started using Zoom, and like we didn't fold a tent. Hey, let's go home because now it's a pandemic. You try to find a way to make it work. So in that respect, what I truly believe is that the chessboard of investing, the premise that I believe gives me confidence for the future is that when you invest in the market, you are buying a stake into a business, and that business will try to make it work irrespective of what is going on, irrespective of the challenges. And right here in your backyard just got me thinking, like, you have BlackBerry. And BlackBerry at some point hit the rough time, right? Like, it's like iPhone came out and I'm like, oh my gosh, what are we gonna do? And what's amazing is that BlackBerry today is actually a very successful company. They figured it out. It took them a minute, but they figured it out. Right now, it is the software underlying technology in 255 million cars. It is the most robust software for automation of safety features and entertainment and so forth in cars. Most people don't know. They're no longer selling phones, but they figured it out. Companies will try to figure out a way to make it work. And I think that is something that we see over and over and over again. Whatever challenge a company faces, they're going to work it out. They got smart people trying to make it work. So to me, are there bumps along the road? For sure. Is everybody going to make it? No. But by and large, I do believe that as long as people are allowed to operate in free markets, that's the key. To me, the chessboard of investing is free markets. Let the companies do what they need to do. That to me is something that even as is different today, I have no doubt that down the road there'll be companies who are going to make it. I just don't know exactly which ones.
I like your analogy of the casino, because in a casino, when you're gambling, the odds are fundamentally stacked against you because the house always wins. Whereas when investing, as information is abundant and you're investing in companies that are in their vested interest, are resilient based on a capitalistic society of always trying to get better and improve. The odds are actually stacked in your favor.
In your favor. And the key there, absolutely, to kind of follow up on that, you don't want to place bets on companies because that's when you become the casino player. The way to become the casino house is look across all the bets, meaning buy every single meaningful company in the world, and play it enough times. Don't invest for a day or a month, invest for the long run. So the way to become the casino player is look at all the bets and don't play it for 5 minutes. Just keep it for the long run.
Right, and that aligns with our view of being diversified, not putting all your eggs in just one particular basket. And we see sometimes there's a desire to be heavily concentrated in one single company or one single sector, but being diversified can also really pay off. And both strategies that your firms look at use this disciplined approach to be diversified, but potentially tilt that portfolio towards the areas of the market that can lead to higher returns over time.
Yeah, absolutely. That's the smartest way to do it.
Apollo, can you talk about how AI might be changing the process or not?
Yeah, and AI, I mean, I was so glad to see that a lot of hands went up because sometimes in the U.S., when I talk to investors, a lot of them are still afraid, like, what if a little hand comes out of the phone and slaps me? No, it's very fine to play. It's like a Google on steroids. Like, go play with it. It's the future. There's no doubt it's going to change our lives in many ways. And I'm not Richard's an expert. I'm not. I was talking to my brother, and he is deeply involved in creating agents and so forth. He works for fintech in Silicon Valley. But it was interesting to hear from him about a bit of a cautionary tale of the current state of AI, because in his company, they did want to replicate agents collecting money. So in his case, it's a fintech that makes loans for improvements, for home improvements and so forth. And every once in a while, people don't pay. And right now they have a collection agency and they call them up and they say, hey, pay back the loan. But now they want to automate this. And he's been testing the system, and it's the latest Claude and whatever they use. But he said it was quite interesting because these agents start developing a bit of a mind of their own. And if you start digging and you ask them, hey, give me like the honest feedback, and he showed me, when he did that, the agent, I knew that I had to write their report, but I didn't. Chose not to do it. Agent didn't have the credit score. I made one up because it was easier. It helped me optimize my. In other words, they develop a bit of brain of their own. So in that respect, I think AI is an amazing technology. There's no doubt it's going to have an amazing future. It's just there's some cautionary tales of some things that are not 100% baked yet. And it's very useful. I like to use it as a tool, but I would be cautious to just go and say, and like, I truly believe everything. It's because there's some devil in that machine that you got to be a little careful with. But rather than talk about that, I want to talk about AI as an investing opportunity. And this is where it gets really interesting because there are some things that you can consider. And the first one is that the investment today in AI is absolutely mind-boggling. In the U.S., there are 4 companies that are putting a lot of money, and there was a recent article in the Wall Street Journal about these 4 companies, and that's Google, that's Amazon, that's Facebook, and Microsoft, and how much money they're investing in AI this year alone. So if I were to give you some ideas, like, okay, you have the highway system in the U.S., or you have the railroad system that was built in the U.S., you have all these big, Apollo 13, all these big endeavors that the U.S. has done over the years, and how does this investment compare relative to the size of the economy to all the other ones? How big do you think this is? The investment of 4 companies in AI this year. It's not. It's kind of like mind-boggling because it kind of goes beyond even the obvious. So these 7 companies basically are investing more than anything else in the U.S. history, and it's only second to the Louisiana Purchase. That's the only other bigger investment that the U.S. made in its history. And these 4 companies alone in 1 year are piling so much money in it. So there's certainly an interest there. There's no doubt. And then these companies are very smart. They're seeing the economic potential. At the moment, though, AI is a huge, huge investment, but not really clean monetization. It's not really cleanly monetized. They're not making nearly as much money as they're spending, and they're expecting that these profits are going to come in. So as an investor, you have to be a little cautious, a little bit cautious. The second thing to note is not just making these investments, but a lot of the benefits of these investments might go to people like Richard because they have systems, they have tools available to them. They're not paying a crazy amount of money for them. So the beneficiaries of AI investments might not be the creators, but the users. The pharmaceutical who can come up with a brand new medication that didn't exist before they were able to use AI. So, be aware that investing too much in AI, it's a cautionary tale. It's early on, and not only that, but it has become very, very expensive. And how expensive? Take a company that love it or hate it, it's out there, and it's bet its future on AI. They're not going to make cars anymore. They cut the Model S and Model X, and that's Tesla. So if you look at Tesla, kind of going back to what I mentioned earlier, now it's bet its future on AI. Robocars, robotaxis, one day robocops, who knows? But right now, if you look at the beginning of the year, if you wanted to own a piece of Tesla, pretty much like Elon Musk, not as much as Elon Musk, but you now partake into the ownership of that company, you would have had to fork out $450 for that privilege. So if you had $450, you can go get a nice Arc'teryx jacket, you can get whatever you want, take your spouse to dinner, or you can spend it on one share of Tesla. What do you get for that? You get to part ownership in Tesla like Elon Musk, not as much as him, obviously. And what is the benefit of that? Well, at the time when Tesla was selling for $450, the earnings that you could have partaken in at the time were $1.50. So let's reframe this. This is an AI company. Let's reframe this. You just spent $450, and at the current rate of earnings, Tesla comes and puts $1.50 per year into your piggy bank. At this current level of earnings, how many years would it take for you to make that initial investment back? 300 years. How is that for an AI investment? Great, isn't it? Wait through, maybe your grandkids will take part. But why would anybody pay that much? Why? Well, there's the expectation that, hey, listen, they're not making that much money, but just you wait. They get things rolling, and they're going to make money hands over fist, and don't bank on, Elon Musk being out. So there's an expectation that AI is going to provide great fortunes down the road. Is it possible? It's possible. But on the other hand, today, you can also look and own a share of Toyota. And when Tesla was selling for $450 a share, you could have bought for less than half of that, $215 a share of Toyota. And when Tesla had $1.50 in earning, Toyota was roughly about $20 per share in earnings, which meant there was roughly about a 10 years payback period. So if you look at these investments today, does it seem foolish to buy Toyota and put all the money in the AI of Tesla? Which one seems like a better investment today? Toyota. That's the idea, is that today these non-AI companies, they're still super viable companies, and they might actually be a better deal because these AI companies have been hyped up so much that you just have no idea if they're going to make it or not. But the expectation is they make it. It's possible, and that's why you might want to own Toyota, but Tesla, but just don't bank on it. And by the way, this is an illustration of what value stock would be. A value stock, no, this is the other one. This would be the growth, the more expensive one. The value would be the Toyota, which is a relatively lower price. So if you want to understand the idea of value growth, is how much do you pay to own something? And in this case, the metric is earnings per share. So that's the second perspective that you want to bring into this, that you want to consider how much are you paying. So you want to own AI. And there are a handful of companies that are associated with AI, and that's the Magnificent Seven. And if you look at the U.S. market, and just to kind of give you an idea, if you look at the S&P 500, which is a measure of the U.S. market, what's really interesting about this market is that the way that you arrive at the performance of the market from 500 companies to a single number is not only by looking at the performance of each company and how they did, but also how big the company is. The larger that company in terms of its value of ownership, the greater the emphasis that you put on its performance. And that's why these Magnificent Seven that have been associated with AI, and this is Apple and Microsoft and NVIDIA, Facebook, Amazon, Google, and Tesla, these 7 stocks are really meaningful to the market. And the reason they're so meaningful is because among the 7 of them, they represent about 32% of the value of the entire S&P 500. 32% of the value of the entire US market is in these 7 stocks that are associated with AI to some degree. Maybe not Apple yet, but it's coming. The same exact 7 stocks are in a different market metric called NASDAQ. And NASDAQ has the same exact 7 stocks, but instead of 31%, it is a whopping 51%. More than half of NASDAQ is in 7 stocks. That's crazy concentrated if you ask me, more than half your money. And the way that we look at it, when it comes to AI, you absolutely ought to participate in that, but you put it in a global context. You want to own these along with the other 12,000 different companies around the world in which you can participate. And at that point, you would have exposure to these Magnificent Seven, but instead of 51 or 32, it would be about 18% in a global portfolio. So our view is that you absolutely want to partake in these companies. They have a lot of uncertainty because of the future monetization. So you don't, in my personal opinion, I would not overdo it. I would keep it at this market level. When you do have Toyota, you do have Tesla, you just don't overdo it in AI. Don't overdo it in AI. And this global perspective, I'll kind of wrap it up. It's so fascinating because AI, it is not a U.S. enterprise. Everybody believes that AI is just U.S. Not really. And this is where it's kind of like so fascinating because if you look at NVIDIA, which is a great success story, it builds the chips that Richard mentioned there. You're buying a lot of the NVIDIA chips. It's an amazing company. And the way to think about NVIDIA is a baker who developed the recipe for the best cookies in the world. They could just make the best cookies in the world. They developed these chips that are just fantastic at processing AI data. The thing is, they don't have a kitchen. They have no manufacturing facility. And in the entire world, on this entire planet, there's only one single factory that can produce their most advanced chips. And they have to fight for factory space with Google and Apple and everybody else who wants chips made there. And that is an investment in emerging markets, and that company is called Taiwan Semiconductor Manufacturing Corporation. Without TSMC, NVIDIA would have nothing to sell, nothing to sell. And in that factory, in that kitchen, there is a very specialized oven, a machine that is science fiction. If they shot a laser beam from here to the moon, it would hit a ping pong ball. If they put a mirror over the entire British Columbia, the biggest imperfection would be 1 millimeter. It is science fiction how precise and incredible that machine is. It took decades to develop, and there's only one single company that makes it. TSMC relies on a single vendor because nobody else makes machines like that, and that is an investment in international developed markets. It's a Netherlands company called ASML. So when you think about AI, the obvious should be, hey, look at NVIDIA. But the reality in this global value chain, who holds the cards? Is NVIDIA the obvious holder of the cards? Is it? TSMC can charge whatever they want. What's NVIDIA going to say? I'm not going to pay you? ASML can charge as much as they want for their machines. Right now, one of those single machines is roughly about $1/3 billion for one machine. What are they going to do? Not pay it? Where else are you going to get it? So to me, and if you, by the way, if you look at last year, both TSMC and ASML outperformed NVIDIA. They did better than NVIDIA. So the point is that you have to have a global perspective to investing. You have to look at all AI companies around the world, and you really have to just put things in perspective. So, do I think that AI is here to stay? Absolutely. There was a parallel to. Anybody heard about the bubble idea? That somehow it's going to be a bubble, and because these valuations are so high, the prices are high, somehow it's going to burst. And the analogy that came along was the internet, right? Did you get a question like that?
I did.
Yeah. So the idea of valuations and bubble. Do you think that it's going to burst? There's like a bubble that somehow boop, pop, pop. Well, the last time that I saw technology as revolutionary was the internet. That's when things changed. When my brother showed me, oh, look, you can pull up a picture on the screen from a website. It's like, whoa, this is mind-changing. I couldn't believe it. Like, you actually can do things. It's incredible. It's the same feeling that I had with AI in a way. And it got me thinking, is there a parallel to the internet boom and then bust? And I got more and more thinking about it. And what I realized is that when you think about the internet, it is not an entity. It is not a monolithic investment, but rather what you have are a bunch of companies. And these companies are like horses in a race. And when the race gets going, is it obvious who the winners are? If I took in a time machine in the mid-90s and I gave you 3 websites, one website that sells toys for kids, another website that sells books for reading, and then another one that sells pet supplies, and I asked you which one of these will obviously be the future of internet retail, how many of you would have said it's obviously the bookseller? Would you have said that? Not with hindsight, but back how you like, hey, I'm selling books, I'm going to be the future. It wasn't obvious at all. So I think the first thing to note is that whether it's the internet or AI, you have to accept that in order to own Amazon, you also will own eToys and Pets.com. You have to accept that. That's not a bug, it's a feature. That's what it is. And what's also interesting is that if you hyper-focus on this idea, oh, but look, Pets.com and eToys, they went out of business, they went bye-bye. What you're missing the fact is that Amazon became Amazon. That some of the largest, most successful companies in human history came from that era. Google is a money printing machine. You have Netflix, change your entertainment. You have all these companies that are the most successful in human history, and they all came from that era. See, if you hyper-focused on one out of business, what didn't work out, you missed the fact that all the other ones changed the world. The internet is a resounding success, even though it had a moment where maybe it wasn't. So this idea, when you have these new technologies, and the same with AI today, it is not about knowing which one will survive. Can anybody tell me, and including you folks, is it Claude? Is it Gemini? Is it OpenAI? Is it Facebook? Which one is the winning AI system? It's too early to tell. So the idea is that today you also have horses in the race, companies that are right now, it's not obvious which ones will not make it. So because of that, you have to own all of them, in my opinion, and you have to accept that some of them will not make it. And, you know, in Silicon Valley, I keep talking about it because that's the hub. That's where a lot of these companies get funded. If you look at the companies that are, Sequoia or Benchmark or Founders Fund or Andreessen Horowitz, these are storied companies that have funded eBay and Microsoft and maybe not Microsoft, but Amazon and Facebook, and they made so much money in Google and all these things. They will all tell you the same thing. When we invest in 10 companies, we know that 6 of them will just disappear. They'll blow through our money, create nothing, go out of business. We know that's the case. 2 or 3 are going to chug along, nothing to brag about, maybe make some money, maybe get acquired. 1 or 2 are the moonshots. They're going to more than make up for everybody else. And I think that private equity logic is now permeating to AI investors. And you have to accept that some of these companies might not make it, and don't get carried away with emotion. Oh, they didn't make it. And because that's again, it's a feature, not a bug. And it's also the history of the US market. If you look over the past 100 years, at the beginning of a 20-year cycle, there are roughly about 3,000 companies that start that cycle. And what's amazing is that after a 20-year cycle, roughly about 60% of those companies disappear. They don't exist anymore. 60% of companies in the US market don't make a 20-year cycle, and out of those, only about 18% actually outperform. Meaning that if you're starting with the cycle, you have a 1 in 5 chance to find that high flyer, and 4 in 5 that you get either a company that does meh or actually goes out of business. So to me, like, AI is really an important moment right now, but you have to pay attention to the fact that they're not necessarily all going to survive, and there's nothing wrong with that. And you have to spread your bets and be to Mally's point, be the casino house, not a casino player, by placing big bets into only one company. So I do see AI as being fundamental, but as an investor, not as a user. Make sure that you spread your bets and don't over concentrate in AI or any one sector for that matter. That's kind of my view.
Really well said. Thanks, Apollo. As we think about diversification, spreading your bets, what about the global landscape? And now that there's so much geopolitics, how do you structure a portfolio and manage it in a disciplined way when you have all of these geopolitical kind of hotbeds popping up, whether it's in Asia, in the Middle East? What's the philosophy on how to structure it profitably
Yeah.
in a disciplined way?
Yeah, and this is before we get to that, and I have to say, something that I've kind of realized is that, we talk about the geopolitical risk, the war in Iran and all that, and there's a human element to this because, there are U.S. soldiers who are deployed and their families who are worried about their kids. There are the local, like the folks who are probably fighting the regime in Iran and they wanted a change and then they found their apartments being bombed. There's a lot of folks are in other parts of the world that because of this, they cannot send their kids to school because they don't have enough gasoline in the country. So there's a real human element to this conflict that we can't just ignore. And what I found interesting about that human element is that it tends to trigger some very strong emotions because seeing those pictures, it's hard, isn't it? I mean, when you see those and it makes you think, wow, this is horrific and it's 2026 and it touches our deeply held beliefs, our core identity as people, as humans, and they trigger the very strong emotions. And I think it's perfectly normal because that's what makes us human. What I also found is that it is really important to acknowledge those emotions as an investor and at the same time disentangle them and make sure that whatever decisions you make about the money, they're not about how you feel, but they're pragmatic. They're based on data and evidence. So that's not to say that emotion is not important. Hugely important. When it comes to investing, you do have to delineate because the market is not really processing morality. It's processing profits. Because that's what the value in a business is. And you want to make it that way. You want that to make sure that if you are buying a share in a company, you're not overpaying. You want to make sure that if you're selling, you're not being underpaid for selling it. So the market has that fundamental function of basically looking at saying, well, how much is this business worth it based on what's going on right now? So when a conflict like this happened, and to give an example, the bombing of Tehran was on a Saturday. That Monday morning, a U.S. airline who has flights to the Middle East and got disrupted operations and all that, what do you think happened to the value of that business? Is it worth as much as it was on Friday before the conflict? No. And you saw that price drop, and it was immediate. It was very quick. At the same time, a defense contractor who might have gotten or likely to get more orders for whatever they produce, what do you think happened to the value of that business? Went up. So the conflict had very different impact on these different companies, but by and large, the Monday after, the price in the market, the U.S. stock market was flat, super flat. And that's not because the markets were asleep and like, oh, wait, there was a bombing? No, everybody knew. But the reality is that based on everything we knew on Monday, what would be the potential impact on earnings for Apple? How many iPhones do you think Apple sells in Tehran? How many Starbucks are in Tehran? How many Bank of Montreal branches are in Tehran? That many? Not at all. The impact on profits based on what we knew on Monday was very limited. And then the Iran strategy emerged. Oh, we're going to block the Strait of Hormuz, which means that everybody became a geography expert, number one. And secondly, it's like, well, we're not going to have as much gas or gas is going to go up in price. So maybe other businesses might be impacted because people have to spend money on gas and not on whatever they like to buy. So the market reacted to that. But the market doesn't. Now, what's also very interesting, and this is really important, is that when the market looks at these events, it is not what's going to happen this month, next month, even the rest of this year. Why? If you think of a business, how many years do you think a business like Exxon or Apple or Google is going to operate down the road? Do you think it's going to close in the next 3-5 years? How many years do you think you'll have ownership in a business that operates right now in the US or in Canada for that matter? Huh? A lot. It's indefinite. The company's going to run indefinitely. So the analogy that I thought, do you remember film? Good old film. The stripper film. I used to develop black and white film. It was a hobby. My dad gave me an enlarger, and I used to process that. And for folks who might be younger and don't remember it, this is what that film looked like. And this is how I think about it. What is going on today with the war in Iran? It is a snapshot. It's a frame. It's a scene. It's what's going on at the moment. The reality is that this is just one frame. The lifetime of a company, it's a much longer running movie where you're going to partake in the ownership and the profits of the company for many, 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 many years down the road. How many years? Well, you take companies that you know, like Exxon, Black & Decker, General Mills, all of these companies, they have been paying investors for over 100 years. Exxon has on their website a list of all the payments made to investors going back to 1911. That's how long the ownership is. So if you put this bigger context, how much does it matter if this conflict lasts another week, a month, or 3 months? If it's resolved in June, August, or September, when you have all these years down the road? Is it really that meaningful for a company? Even for a politician like Donald Trump is going to be out of the office in a couple of years or so, 2.5 years. Does it really matter when you have companies that are going to be there for so much longer? And because of that, the reaction of the market to the war has been not only muted, but has been uplifting in a way. Like the market dropped for a minute and then it just came back up. But that's not the market's irrational. It's just basically saying, hey, maybe the worst case scenario got taken off the table. And then we have such a long time horizon for these companies that in the grand scheme of things, it might not matter as much. We're hyper-focused on what's going on in front of us right now. But think about this. These companies might be around to give you some form of payment for over 100 years. And how much does it matter the next 3-6 months? Not as much. But emotionally, it hits us a lot more. And we've seen situations, by the way, another question come about what happens if it gets worse? What happens if this gets worse? And I was talking to my mother, and there are a few things that she said that were quite interesting. The first thing that she said is that, listen, whenever the Iran war happens, companies and individuals and societies, they tend to become more resilient. I was like, Mom, you're quite wise. What do you mean? And she kind of reflected back on something that I thought it was quite interesting. When was the last time there was a big oil crisis? I'm not sure if it was Canada, but in the US. That was in 1973. And what happened in 1973 to show their displeasure with the US policies in the Middle East, these countries, the Organization of Petroleum Exporting Countries, OPEC, decided not to send oil to the US. They just sent no more oil to the US. And at the time, there's not much being produced domestically, or in Canada for that matter. So what happened? Well, the politicians said, we want to help the people, and we're going to put a cap. The gas price is going to go from 40 cents to 50 cents a gallon. You can't charge more than that. And people felt more than cozy. But what happened was, because there was no rationing mechanism through pricing, people felt good. But at the same time, you know what happened? Shortages. This is what my mom was talking about. In 1973, there were people in those cars waiting for hours and sometimes days to gas up. If you're one of those suckers, how would you have felt? How would you have felt like the world's coming to an end? Like we cannot even put gas in our cars? That's terrible. Like this is horrific. But what emerged out of that? What emerged out of that, instead of those gas guzzles that you see there, the U.S., hey, maybe we should make more fuel-efficient cars. Maybe we should have a speed limit on the highways. But the most important one that emerged was this idea of energy independence that did not exist before 73, 74. And the idea is that we want to produce energy domestically, and today the U.S. is a net exporter of oil. Why? Because of that challenge that came from 73, 74. So to me, the pandemic is another example. Supply chains, oh, this doesn't work. How do we make it work? So my guess is that this particular situation will make U.S. companies, Canadian companies, global companies stronger. It feels terrible right now, but I do believe that at the end, everybody is going to be resilient and innovate, and we're actually going to be stronger as a world than before we were. But the other big one that she mentioned was World War II, because that's really the mother of all of them. If you talk about different, World War II is the different time. And I do have the curiosity to look at what happened to an investor during those times. And if you go back to September of 39, when Germany invaded Poland, you see the bombs falling and you say, this is horrific, this is done. I mean, this is as bad as it gets. Would you have felt scared as an investor? Yeah, for sure. But let's say that you somehow had the stomach to stay invested in the market, and the only stock market had data at the time was the US, so you couldn't look at any other market. But let's say you had the stomach to sit through 6 years of war through the end of August when Japan surrendered. How badly do you think you got for your money? If you had invested $1, how badly do you think you got it on investing your money? Pretty bad? It actually doubled. $1 invested at the beginning of the war would have pretty much doubled in 6 years of war. 6 years, not 20. 6 years, you would have doubled your money in the US market. Just leave it alone through the war. And we got pulled in, obviously, in December of 41 with Pearl Harbor. And if you actually look at the full years of US engagement, 42, 43, 44, and 45, every single year, the market went up in value. Every single year. Is that because war is good for business? I don't believe so. It's not at all. I mean, if you're a car company and all the buyers are fighting on the fronts around the world, what are you going to do? Who are you going to sell to? But it's this idea of innovation and getting creative and free market, something that I talk about when it's different this time. And how do you look at that? I lived in Michigan, and one thing that stuck with me was somebody told me like how these car companies navigated back to World War II. This is like 20 years ago when I lived there. And at the time when Cadillac could not sell their cars, what they did is they put their engine into a tank and they sold that to the government because that's what was needed. When Ford couldn't sell their Model T, they built airplanes. You know, the toughest Fords ever built are not the F-150s. They're the tanks that they built during the war. And that's when Jeep got started. Coca-Cola would not be what it is today without World War II. Because they figured out, hey, these soldiers, these boys, they like the taste of Coca-Cola, so why don't we actually build bottling plants around the world to serve the army? And those bottling plants stuck around afterwards, and now it's a global company. To me, it's all about free markets. It's all about free markets. Somebody's going to need something, and to me, it's kind of the same with the geopolitical risk. Think of it as almost like not an opportunity in the short run, but in the long run, there's a resilience and innovation that's going to benefit all of us, which might not be evident at the moment, but that's kind of my contention.
I love it. Now we're going to open it up to questions from the audience. So I know you're itching to ask Richard and Apollo some questions from what you just heard today. While we're waiting for questions, and please feel free, put your hand up and ask anything you like. I'd like to ask Richard and Apollo just to jam a little bit on the idea of how important discipline is when working with data, when at the same time being open-minded to new factors, new models, new insights that come from AI. How do you balance the two?
I mean, from our perspective, it's just understanding what the relationship between the data you're modeling in the returns that you're seeing are. I mean, I'm very much, maybe an example that speaks to what Apollo talked about earlier. I mentioned earlier, when I first started doing this way back in 2001, 2002, one of the signals that we traded was analyst revisions. So you would wait for an analyst, you got a database that said, where's an analyst upgrading his earnings and downgrading his earnings? And you would buy the upgrades and sell the downgrades. Now, way back in 2001, that was a super profitable strategy. For like a 1 unit of risk, you would get a return of about 3%, right? So 1%, 3% information ratio, we'd call that a 3. Today, if you wait and trade an analyst upgrade and an analyst downgrade, it's zero. US high cap equities, to Apollo's point, that information's priced almost immediately. You won't make any money from buying the upgrade and selling the downgrade. However, imagine you had a crystal ball and you could perfectly forecast all the upgrades and all the downgrades 1 month before they happened. And we can actually test this, just assume that we had the data 1 month before anybody else did. For a unit of risk, the return's 15. So information ratio of 15. If I run a portfolio at 1% risk, I'm going to make a 15% return. Now, nobody can do that, but that's the game. That's the sandbox that we are playing in through everything that we're trying to do. We're trying to forecast where the upgrade and the downgrade is going to happen. We're trying to forecast where the market doesn't understand where profits are going to go up or go down. We're going to forecast what companies are going to beat or miss their numbers. And that's how we, coming back to the question on discipline, that's how we get comfortable that all of that cool stuff we looked at earlier is working. We can basically show a backtest. We can build the portfolio and watch the return. That just tells us there's some link between the data and prices. It doesn't tell us what that link is, and it doesn't give us any confidence at all that that link will persist into the future. So at all times, we're trying to understand what's the relationship between the data we're modeling and the return, the bit in the middle. And it usually comes down to our ability to forecast, not perfectly, not with 100% accuracy. No one can do that. We don't have a perfect crystal ball. But if we can do it, get it right, and again, come back to the breadth point, 51% of the time, and we do it over every stock, every single day, that's when you get back to this idea of the house winning in the casino.
I love that point. It brings me back to one of the analogies in tennis. And we have some very good tennis players in the audience over here, looking at Jerome. And one of our favorite sports analogies is the fact that Roger Federer, one of the greatest tennis players of all time, he's won a number of matches, trophies, more than any of us can dream to achieve. And how many? Is it games? What percentage of games has he won in his career? You have a guess? Okay, some of you.
Games. Matches. The whole match.
Okay, matches. Okay, that's different than games, matches.
Because he's the all-time greatest.
All-time greatest. Percentage of matches.
So when he plays a game against,
A match
against Novak or somebody else, like.
Okay, normally people say, he must have won like 80% of his matches.
82% to be precise. 82% of the matches that he played, he won. Yeah, 82%.
But in terms of games?
In terms of sets.
Sets.
So if you roll backwards within the game, so if you look at all the sets that he played.
What's the percentage of sets that he's won? Go ahead.
It's 75%. So he won 82% of the matches, but he only won 75% of the sets. But the question that Miley asked, which is really good, what percentage of the points? Because as you know, a set is made out of points, and the game is made out of points. What percentage of the points did Roger win in his lifetime career? Again, he's arguably the all-time best. So if you watch him play a point, what were the odds that you would see him win that point? 54%. The all-time greatest lost roughly half the points that he played. If you watch him play a point, was it obvious that he would win it at 54%? No. But then he stuck around, played all the points, won the big ones, and then he moved to 75% of the sets. And then he moved up to 82% of the matches. So it's very similar to investing. It's crazy similar, by the way, because the percentages for the daily stock market is pretty much identical to Roger's winning percentage. On a daily basis, the U.S. market goes up about 53, 54% any one day. It goes up about 70+% any one quarter, and about 80% or so every 1 year. So it's exactly the same lineup as it is with Roger, which is quite remarkable.
It really is.
Yeah, incredible.
So I have a question. We focused a lot on analytical of thousands of businesses and stocks. How does water and energy fit into all of that scenario? Because without energy, this meeting would not happen today. And without water, we may not have lunch.
Well, from a company-specific point of view, we actually find that companies that are good at managing things like their carbon footprint, in managing their water usage, in all of those types of themes, are also pretty good at managing other more traditional costs. And there tends to be a very clear link between those types of measures. We have data that tells us, what any company's carbon footprint is, whatever any company's water usage is. Most companies have to disclose it to some regulator somewhere, and we can make that link. And actually, we tend to find if they're getting better along those dimensions, that tends to be pretty good at forecasting margins going forward. Another scenario that our models have picked up on, probably about 12, 15 minutes. And again, I think it speaks to what Apollo talked about. You've got the Magnificent Seven, the big hyperscalers. In all honesty, for us, that was really a theme in 23, 24. That's when the markets became more concentrated and we were able to get overweight those big tech companies and do very well from that. If you look at how we've been playing AI for the last maybe 12 to 18 months, it's been moving much further down the supply chain and much further down the capitalization spectrum. And one of the themes that we've picked up on is this idea of the demand for energy. And basically, if you look at our portfolios today within the industrial sector, you're going to see us overweight companies like Mastech, Emcor, that are very much geared to this whole idea, the need to build out infrastructure to get power and energy and transmit it to where it needs to go. And that's been a sort of sub or secondary theme that's come out of this whole need for AI, the build out of the infrastructure and the demand for energy.
So I think that there are two, maybe I want to distinguish the question. So when you're talking about water, are you talking about investing in water?
That, but also communities that are struggling to have water sources are going to be struggling economically, and countries in the bigger picture, like Europe or North America, that have plenty of water, companies are going to be more successful perhaps, and same with energy.
So water is an interesting one because it is not typically that easy to invest in water, because water is a public good that has been regulated by governments, the US government, Canadian government, and every once in a while, to your point, there are situations when the water just runs dry, like there's not as much water. And I think to me, a good example would be San Diego. San Diego at some point, as you know, Los Angeles and Southern California is pretty much like a desert, and it started running out of water. So that's when the creativity came in, and similar to Israel, where you don't have a lot of water. And what they said is like, can we build desalination plants and then cut usage? And today, what's amazing is that San Diego is a net exporter of water. Israel is an exporter of water. So there are definitely going to be challenges. Now, investing in those technologies is a pretty niche type of investment, because if you do have rainy seasons, you're going to end up saying, well, how am I going to pay back for this investment? Because that's expensive water. Nobody's going to buy it. So I think you can think about investing in those, and you can think about the challenges. You can also look at the opportunities, and they are part of your portfolio. A lot of these companies who create the infrastructure for water desalination, all that, they are part of your allocation. Energy is very similar in some ways. It is a public good, and it's regulated by utilities. And in the U.S., I don't know about you folks, but in the U.S., a lot of communities have started pushing back on AI, because AI requires data centers, and those data centers have two major requirements. One is water, because you need to cool off the processors, and then two is energy, electricity. And a lot of communities have said, what if we put this in our backyard? We force our electricity company to basically upgrade and buy more things, and then the AI goes out of business. How are we going to pay for this big new infrastructure in electricity? So you are seeing communities in some respect doing it. Now, what are the solutions? There are two right now. One is a lot of these AI providers, they're building and they're buying gas generators. And these companies making these gas generators, their performance has been through the roof, because they realize, boy, we have a lot of demand for this, and they are sold out for years to come. But that was reflected very quickly in the market once the realization happened. So by the time you get to participate now, you're probably paying quite a bit for those companies. And the second one is in the US, there is a big push for nuclear energy, but not just the big, not the big plants, but rather, VW buses, that size of a reactor that you can drop it off somewhere, and then for years you have electricity. And a lot of these are private companies, and most of them are private companies. Even Donald Trump and his company got in this business because they see a future in this. Now, how many of these will actually have a legitimate product that's going to be safe enough to deploy and economically viable remains to be seen. But the valuations of these companies, if you want to participate in that, first of all, is not easy to get in because they're private. And second is the valuations have already reflect just tremendous potential down the road. So everything you're buying today, whether it's water, electricity, it's already reflecting that. But as a societal problem, I do believe that it's a different issue. And I do think, particularly being public goods, you have to look at the government, particularly in each country, in each county, in each state, to see how they manage that.
You've just given me a really good idea, actually. I mean, we track about 100 million mobile phones all over the world. So we know who's in well, not individuals. We don't care about anyone's personal information. We don't want it. We don't need it. But out of that 100 million phones, we know who's in a Starbucks today versus, or how many were in a Starbucks today versus last week versus last year. We also have geolocation data that tells us where pretty much every company in the world has its manufacturing, its operations. We have data that tells us about logistics, shipping, trucks moving around. So we pretty much know where consumers are active and where companies are active. And I don't know if we have the data, but I bet it's out there. But if we can see that water shortage or energy shortage is starting to impact consumer behavior or companies' abilities to manufacture their goods and services, we'll be able to play that in portfolios. So thank you.
Great question. Thank you. Final takeaways I'd like to share, Richard and Apollo, for our audience to take with them into the rest of the afternoon.
Well, go ahead.
Oh, yeah. Well, I think the world is changing. And for us, it's changing in a way that is incredibly beneficial and gives us a massive opportunity. I think we've always been very good at knowing a little bit about a lot of companies and a lot of businesses and been able to play that percentage game. As long as we get it right 51% of the time, we're going to make money. And what AI in large language models is giving us is an ability to know a lot more about any one of those businesses. So what was always 1 mile wide and 1 inch deep is now 1 mile wide and 1 mile deep. And we're already starting to see the impact of that coming through in the outcomes we're delivering for our clients.
To me, the biggest takeaway for all of you folks is that it is a changing world. Things are different. And I cannot think of a better time to actually have a financial advisor who looks at your specific circumstances, your needs, what allows you to sleep at night, all these other factors that are really relevant to your financial situation, and develop a financial plan. It is no longer the case where you can wing it and just basically buy products without understanding how they fit in your financial picture. I think the most important element in investing is having Miley and the team and have a financial plan. Make sure that you balance all the trade-offs in investing. Make sure that you look and put some safe assets, that you have some reserves. And if something happens, what if that means nothing for your portfolio, for your investments? What if I told you that the war in Iran means nothing to your ability to retire or the ability to pull money in retirement because you had that plan? So I think that we can talk about all these things, but ultimately the most important thing is to have a financial plan. And that financial plan is going to account for your circumstances and account for all the things and find the right products for you, but it's not about the product. We talk so much about investing and what's going on. It is all about the advisor. It is all about the financial plan. And without it, I have no doubt in my mind that you can have the nicest jet. If you don't have a flight plan, you're going to crash somewhere. So you need to have that flight plan. And to me, the only way to get it is just sit down and revisit it. And if you're anxious about what's going on, maybe you'll be surprised to see that your portfolio did not go down that much, if at all. Maybe you'll be surprised to say that you have a lot of conservative assets that you can pull money out of. So all of these has been planned. Nobody tells you when the next crisis is. I live in LA. I'm under no illusion that I'm going to live my life without an earthquake. I know it's coming. I can do nothing about it except prepare. Don't forecast the earthquake. Prepare for it. And that's what the plan allows you to do. If there's, knock on wood, a situation, you have the right things to guide you through that. And to me, it's all about the plan. And this was designed to give you a little bit perspective on, in my opinion, about what's going on in the world and how to think about investing in general. But there is no substitute for Miley and the team and the plan.
Really well said, Apollo. Thank you. It reminds me that, data drives decisions.
Right.
And discipline drives outcomes, but essentially the financial plan holistically brings it all together and makes it relevant and keeps you on track and helps you achieve all those goals. And that's why I think we're really grateful for the trust that all of you have in our relationship, because that trust allows us to be able to work together and collaborate and maybe make sure that you can drive better outcomes. And also grateful for partnerships with some world-class organizations and two incredible individuals and speakers today. So let's give a round of applause, please, to Richard and Apollo. Some key themes that came to mind, we talked about global diversification. We talked about using AI as a tool to help us drive better decisions in the investment process, but staying focused on anticipation, thinking 2 steps ahead of what can go right and what can go wrong, building in resilience to the portfolios and to the process, and thinking long game, continuity. The examples of companies that have stood the test of time, and looking for those characteristics that lead to those long-term outperformance numbers. And all of that comes back to trust and relationships. And closing with an analogy that Apollo used that I think got us all hungry, talking about chocolate chip cookies, my favorite, is that we have now lunch prepared for all of you to please enjoy and stay and enjoy with us today as we continue the conversation. And of course, my team and I at the Wong Group are always here to help answer any questions that you have. And we would love to spend some more time with you and be here to answer any questions. So thank you all for your time today. We really appreciate you being here.